So we started in multifamily and, I've done a couple of large apartment complexes in that space. And just through connections in the industry, my dad wanted to put a vineyard on the family ranch, just small, 20, 30 acres. And an operator heard us telling that story on a podcast, reached out. He said, hey, we need your help. We've got a 350 acre vineyard here. We want to build a couple thousand more, but we don't know how to do it. We don't know how to brand, how to market, how to attract investors. We need the business experience as well. So off to the races. That started last year, and we underwrote it for about a year and a half, but we kicked off our first vineyard block last year. Got 600 acres going, putting another 350 in the ground next year. And it's been a wild ride, but just full of unexpected blessings. So it's been a ton of fun.
In today's matchup, we're bringing together two very unique ways to invest. These are both really cool investment types and are great ways to diversify, have some fun with your investments, and generate some great returns along the way. So let's introduce our guests. Fighting out of Fort Worth, Texas, and representing vineyard investing, that's right, Vineyards. This pugilist is fueled by a passion to help others achieve their life goals. She comes from a background in financial education, is a high-ticket sales coach, business strategist, public speaker, event MC, podcast host, agriculture and multifamily syndicator, and my personal favorite, a high-energy TCU horn frog. Go Woo-hoo! Frogs. She's on a mission to be the largest vineyard operator in Texas and dominate the Texas wine grape supply while bringing amazing investment opportunities to investors so they can build generational wealth and gain financial freedom. Please welcome the Princess of Pinot, Keeley, the Grape Crusher Hubbard.
Yeah, I've never had an intro like that. I'm like,
yes,
wow.
That's right.
Yeah. Thank you. That was amazing.
And fighting out of Lakewood, Colorado, representing outdoor hospitality investing, this dynamic duo formed their partnership while paragliding in the Rocky Mountains. Pairing deep backgrounds in real estate, brokerage, and a huge love of the outdoors, they formed a formidable business venture, all fueled on giving you access to adventure. They're also on a mission to help investors build legacies, create multi-generational wealth, and achieve financial freedom, all while having fun. Please welcome the Campground Crusaders, Adam, the Leaping Legend, Lendi, and Justin, the High Flyer Hoggatt.
Woohoo!
Welcome to the show, everybody.
Thanks. Thanks, guys. Ready to square off. Here we go.
That's right. Get ready to go. We're going to have some fun. All right. So let's see. Like I said, as a reminder, we're going to have 3 rounds before we crown the champion. And round 1 is going to be all about getting to know you and a little bit about your personal background, what took you where you are today. Round 2 is all about your business model. What is your investing all about? And then round 3, we're going to give a final pitch for why you and your cash flow model deserves to be the title of Cash Flow Flight Club champion.
And let's kick off round 1. Ladies first. Keeley, the beautiful Countdown girl. Please let us know a little bit about your personal life and what was going on before your Vineyards chapter.
Thank you. Yeah. So got into investing about 2017 into the multifamily space was how I got into syndication. I quit corporate in November of that year as VP of sales, got tired of building somebody else's empire. I'd been in business with my dad before, but now that I'd quit corporate, I had more time just running my own consulting firm. And he was like, hey, I'm leaving the financial markets. I'm getting into real estate. We're moving into hard assets. He was a financial trader, hedge fund manager. I was on the education side. And so, if y'all know my dad, if you ever meet him, of course it was a heck yes, I'm in to do business with him. So we started in multifamily and, I've done a couple of large apartment complexes in that space. And just through connections in the industry, my dad wanted to put a vineyard on the family ranch, just small, 20, 30 acres. And an operator heard us telling that story on a podcast, reached out. He said, hey, we need your help. We've got a 350 acre vineyard here. We want to build a couple thousand more, but we don't know how to do it. We don't know how to brand, how to market, how to attract investors. We need the, the business experience as well. So off to the races. That started last year, and we underwrote it for about a year and a half, but we kicked off our first vineyard block last year. Got 600 acres going, putting another 350 in the ground next year. And it's been a wild ride, but just full of unexpected blessings. So it's been a ton of fun. That's awesome. What brought me to today. Yeah.
That's awesome.
How has it been in the family business? So I think each of you are going to have a little bit of aspect of close connection business partners, but you and your dad work well together, all that kind of stuff.
Yeah, we've been down this path before. I think our second time around, we're a lot better partners than we were first time. First time was back in 2010. And just, me being immature at that point and not knowing how to really communicate with my dad. I have a lot of respect for him. The older you get, the more you respect your parents, just, how it happens. We've got a lot of wisdom to provide. And so I think us learning how to operate within our own strengths and also respect each other's strengths as well, and learn how to communicate has just made it, just amazing. I'm very, very grateful to be in business with him.
Yeah, that's awesome. I mean, we get that question all the time about, working with your spouse, and it's great. I think it all is founded on a great personal relationship to begin with, right? You have to be able to have a give and take and work through conflict together and not get defensive and all that kind of stuff. And so it can go bad when it goes bad, but
it's usually good. The tone. It's usually the tone you used when you said something.
Yeah.
Yeah, and there's a natural hierarchy there with the father-daughter.
Yes, there is. We've gotten really good at it, though. We're not perfect, but we've gotten a lot better. So.
That's awesome. Love it.
Happy campers, the floor is yours now. We'd love to know how you met and what sparked the interest for you guys to join forces together.
Well, thank you, Lydia. Oh, yeah, sorry, I'll jump in first. I'm jumping on top of you there.
No, I was about to say, how did your path looked leading up to this venture?
Yeah. So, and I'll give you a little background on me and then where our paths meet, and then I'll let Justin take over on his side. My background is like most people who got into real estate. It wasn't my first; it was my third career. I started with a career in commercial construction, doing low voltage, and went into a law enforcement spell in my life, where I was a police officer for about a decade. That was a fun, wild ride, and as I always say, a young man's game. But while doing that, I started building my single-family portfolio. Ultimately, realized real estate was something I wanted to get more involved in. Got my license, thought I wanted to be a broker. Got into that side of things. Did really well in that, and that's where Justin and I crossed paths. I picked up paragliding as a hobby, as you alluded to on the introduction. There's a chapter of the here in Colorado, a paragliding club that we were both a part of. I was the president at the time, and he was a regular pilot. So we met actually on top of the hill and started talking. Realized that
How old were you in this time frame?
This was just
like 3 years ago,
3 or 4 years ago.
So not like a teenager or anything. You were kind
of no. So we kind of realized that we had a lot more parallels than just our hobby. Justin was in real estate as well. He was a little different stage than myself. He was the single family, multifamily guy. And, I looked up to him because he had a lot of properties, a lot more doors than I had. And then, we had a bond over that, but we quickly realized that our wives were also in the same industry, both being mental health therapists, and that he had a daughter about the same age as my daughter, and he had a son about the same age as my son. And, heck, we even had German Shepherd dogs, both families. So it's just this really weird parallel between us. We got the show kicked off and got the families together. And, this whole business idea was hatched on a camping trip. Actually, we were out on a houseboat on Lake Powell, and that's kind of where it spawned. And then we were camping when we started really laying the groundwork. It was only a couple months later that we started forming Happy Camper Capital. So I'll let Justin give his intro and we go from there.
Yeah, thanks, and glad to be here, guys. And just a couple of mentions. I started a little bit into my real estate with my wife, and so I can certainly share the sentiments of working together with the spouse. We've done a lot of deals together, a lot of back and forth and strategizing, and a little bit of fighting. But I can say that we were actually never closer when we were working together in that capacity too. So I kind of miss it in a way. And then Keeley, kind of going along the lines of being involved with parents. They have certainly helped kickstart my career in the real estate business. And it all started over a decade ago when I turned my first house into a rental. And my father-in-law helped us move into a new home, which allowed us to keep that original rental and cash flow and moving forward. And so over a decade ago, I started buying single family homes. Decided to change my trajectory with multifamily and started buying those assets. And my father jumped in on an investment opportunity. Luckily, he was a silent partner in that deal. So didn't have to fight him too much, but gave him a great return. He gave me basically that in return for the work I did on the property, and used that into a next one, 1031 exchange, as we all are well aware of. And then worked with my father-in-law on additional apartment buildings in Denver. So it's definitely ingrained in the family. My father-in-law has been in it 50 years. And so I had a great mentor in him. I have some other mentors in town that really helped me get started too. And then just thinking about the cash flow opportunities in the campground business. When we were on the road a year ago, we were really looking into opportunities in that space. When we were on the road as a family of four, doing homeschooling, traveling the country in our fifth wheel, and just really took it to heart. And it took a few years to kind of get that off the ground. And I found a great opportunity in Adam, and figured we could do some great things together. So here we are.
That's awesome. Yeah. I love that. Like I think so many business ideas come in the moment, right? When you're somewhere and you see a need, or you feel, man, we should have something like that. And it's great that you guys actually capitalized on it and took action. I have so many of those, and I'm sure we all do, that, float through your head, and it's something you think about, but then, that spark doesn't hit to actually act on it. So that's awesome.
Yeah.
That's right.
And when you're on a lake and not much to do except talk,
drinking beers and throw it, the ideas really start flying.
Yeah.
Yep.
That's great. And working together, you guys, how long have you been a formal partnership in this? I guess
we started this venture officially this is about 2.5 years ago. 2.5 years ago is when we were on that Lake Powell trip, and we came up with this whole plan, and we really started galvanizing it about 2 years ago, and this was never meant to be more than just something we did with our two families. Right. That we originally thought, Justin originally approached me with, hey, I've got this idea. If we buy 3 or 4 campgrounds, we can do really well with that. And of course, neither of us can leave well enough alone and, think small like that. So, the next question, of course, was, well, how do we buy more than 3 or 4?
Yeah.
How about 100? How can we buy 100 campgrounds? I think is how that conversation went. Well, we're going to need other people's money. Okay. Yeah. So, we were Googling, how do you syndicate? We actually, this happened. We were calling everybody we could, getting attorneys on the phone. And, we learned probably the hardest way possible, but we've since built out a team. We've got a team of 8 now in Happy Camper Capital. And then our operations company, Beyonder Camp, has its own in addition to our campground staff, we've got 4 operating campgrounds that are staffed. We've got 2 full-time employees there who are managing the operations on that side.
That's great. Yeah, it seems like, and Keeley, I think you probably around the 2-year mark for you guys, if not maybe just a little bit less, but at least from a concept, I think it probably took a bit to get started. I know you're into your second. And, but
we had plans to launch it, before COVID hit. So
okay.
We just we took 2020 off and just spent more time underwriting it and really planning out the business model, and then launched it last year.
That's a great segue. Let's jump into the business model aspect. But it's always incredible to me, every time I talk to somebody in real estate in particular, but it feels like while the journeys can be maybe slightly different, they all have these similar themes and threads and kind of pull from one another. So that's kind of cool to hear everybody's story. But let's get into round 2 then. Let's say Happy Campers. Why don't you kick us off on this? You've already touched on your business model a bit, but what is hospitality investing all about, and kind of in your business model, and how do you syndicate your deals, and just kind of tell us a bit about it?
Sure thing. So we are outdoor hospitality products. They're as much a business purchase as they are a real estate and asset purchase. So our underwriting is obviously looking at the real property and the assets, but we spend more time working on the actual performance of the business. That's where the most torque comes to increase the values of these, to increase the cash flows on these. So, it's a lot different than looking at, say, a multifamily property or, something else that's going to have a fairly predictable income. One of the things we love about this asset is there is a lot of room to really bring the revenues up, because our model focuses more on the transient side. So the less than 30-day guests. We want vacation destination properties. These aren't, long-term residences. In fact, we prefer not to have that. Even though some people like the security of having a whole campground full of long-term tenants, we know that if we can get the nightlies, we can get a lot more revenue per night. We can utilize software to really ratchet that revenue up through a process we call yield management. So just based on where the occupancy is, the rates go up with it. And not to mention the ancillary revenue streams. I always like to say that, they're near limitless. It's really only bound by your imagination, because I feel like every time we feel like we've maxed something out, we find another opportunity to add something else that we can sell, another service we can provide. So, ton of fun in this space, a lot of opportunity. With that comes some very complicated underwriting.
What are some examples of services that you guys have offered at your properties? And
activities more than anything. Renting paddle boards. We have an activities coordinator at our parks and locations to bring together the families. We have community fire pits. We have volleyball pavilions, game rooms.
It's more service-oriented type stuff. I'm
definitely
sure
more service-oriented. And as Adam alluded, it does create a lot more staffing and management of such. It's not a typical multifamily where you rent it and you're kind of, you just take some phone calls. It definitely requires a pretty big staff on park. And also, as he alluded, we are running Beyond Our Camp, which is our sister company that manages the locations. We did want to maintain the control of the properties ourselves, and the people that are overseeing those locations, and just having different opportunities to bring families together is really what we're about, and that's why we did it. As we talked about, because we want an asset we can use as well and have good cash flow.
Yeah,
it's still based on the CapEx type of structure. So when we're buying it, we're still underwriting it in that way too. So
I was going to say not too dissimilar to the multifamily in that it's a value add play. It's just the value is a bit different. And as we all know, I think, because we're into multifamily as well. But the real challenge and execution comes after the close, right? So you have to run the property, and you have to execute a business plan and do that stuff. So it's I love the fact that you guys are vertically integrating your property management, so to speak, or your activities there.
Yeah, it was crucial. When we got into this, there weren't very many service providers providing third-party management for campgrounds.
That's a lot of mom and pops, I guess. Is that what you're kind of,
That's correct. Yeah, the industry's still mostly mom and pop. It is converting. We are seeing a ton of players get into the space who are buying up these campgrounds and institutionalizing it. But when we got in there, really only a couple of players providing management. And, us with our own backgrounds, we know that nobody, from single family, multifamily, we know that nobody knows the pain of vacancy like the owner does. The operators will never appreciate it the same. So we wouldn't have trusted anybody else anyway, even if we had enough other options. So it was really certainly building three businesses at once, if you count our acquisitions team, our investor relations operation, and the management side. So it was no doubt a relief when we were able to finally start salarying people and handing off some of these positions that we've been wearing the hats for.
That's awesome. What about the syndication side of things? So how does that work for you guys? Do you have minimum investments? What are your typical returns? And do you get cash distributions similar to multifamily syndications and that?
So we started off, we had a mission of helping everyone we know get into our investment opportunities. We really didn't want to exclude anybody, especially just knowing where I came from, knowing the journey I went on. So we took a bit of a risk on early investors, and we decided we would keep all of our opportunities at the beginning open 506B. So non-accredited investors could come in on those. Obviously, we put a lot of onus on ourselves to make sure that they were the right partners. And to date, they've all been great decisions. We haven't had a bad anything come back on us with those yet. Our first opportunity was, for us, it was insurmountably big. It was a $650,000 raise that felt like we were raising $1 billion. We might as well have been at that point. Yeah. We had a $25,000 minimum, and man, we celebrated every $25,000 we got. It was just us, grassroots, friends and family, calling everybody we knew. Mm-hmm. And we were, by the skin of our teeth getting this deal done, hitting our deadline to get it closed. We've since then expanded our investor relations team. Now we've got a couple of experienced guys. We've formed some partnerships along the way. We're doing one-off syndications. So just, one deal at a time. For our first few, of course, that creates the fire drill. If anybody who's raised capital knows that by the time you get through your diligence and you get your pro formas written, you get to a point where you can actually present something to somebody, you don't have a lot of days left in your contract. So you're now, stressing about, you're losing a lot of sleep over raising the money. So we were also realizing that there was opportunity we were leaving out there. So we just launched our first fund recently. We launched a $25 million fund. It is 506C just because we needed to be able to market this. But obviously with the goal being to get multiple properties and diversify. The benefit being we have multiple markets we can play within to create smooth cash flows. And this one's got 100,000 minimum.
Okay, nice. And so 25 million. What is that like? I'm sure all properties are maybe even wildly different depending on that. But is there like an average purchase price or?
So the goal of that fund is going to be to leverage it with debt. We're going to be also raising for CapEx in there too. So we'll be buying in total about $55 million worth of real estate with that fund once we put everything together. So based upon our purchase price, we're going to be looking somewhere at about 6 to 8 properties are going to fit in that. Just depending on the deal size ultimately and what makes sense to go into it.
Nice. And then do you guys do cash distributions out of your properties and or total return type things?
We do. So we do quarterly updates and distributions with investors when the distributions are available. And yep.
8% pref is where we're headed.
Okay.
And then structure 65-35 on the deals.
Okay. Nice.
Yep.
And are there, I think I saw that you guys do, different types of properties, right? You have campsites, RV parks, marinas, different things. Do those all kind of fall in a similar, or do you underwrite them in such a way that they have a similar return profile, or can they be very different? How does that?
The underwriting is very similar on marinas and campgrounds that we're buying. Now, we should caveat this with, we aren't buying full on 100% marinas. We're buying marinas that have campground businesses that have a marina.
Okay.
So we know RV really well. We're getting to know marina pretty well, but really RV is our core focus. So just we know that model. Marina does operate very similarly. There are some long-term models. There are also transient models within that. So really the same opportunities exist.
And the properties do have motels. One of them already, one is coming with that. So we just really focus on the outdoor hospitality aspect. I think it all does relate. And then restaurants are on site. We have, different revenue streams on property. And we just really do, kind of as Adam said, our core focus is the campgrounds. If we need to lease the space as appropriate, we will. But as we all know, people are the most important asset of all. And we just make sure we get the good people running those properties.
Yeah. The right people on the bus. That's right.
That's right.
Cool. All right. Thanks, guys. Miss Hubbard, why don't you tell us a bit about vineyard syndications and how the ins and outs of that?
Yeah. One of the biggest questions we get is people, a lot of people think, oh, you're doing a winery. And we're actually not. We're way back at the beginning of the supply chain. So vineyard is a fancy way of saying grape farmers, which is really what we are. Yeah. We are growing wine grapes and crushing those grapes, selling the juice to wineries. So we're just involved in kind of that beginning process of the supply chain. That's where the biggest opportunity is here in Texas. There's the reason that this came about, and for my dad and I, it was a no-brainer, is because Texas is, a lot of people don't realize this, but the 5th largest wine grape growing state in the U.S. There's a lot of wine production here, but it's all consumed in state. You're never going to see a Texas wine that shows up in a Colorado grocery store. So it's all consumed here in state. The problem is there's only about 50% of the grapes being produced needed for the wine consumption. So we're only producing half of what we actually need. The wine demand continues to grow. There's a law here in Texas that states that a winery cannot label it a Texas wine unless 75% of those grapes are grown here in state. And so a lot of these Texas wineries are frustrated because, some of them won't even label the wine Texas unless it's 100% grapes, and they don't have enough. They just can't find enough. So we're trucking in grapes from California. If you've ever met an obnoxious Texan, we don't like that. We want Texas to be Texas. If it's Texas wine, we want Texas grapes. There's a lot of pride inside of the state. And so it's a big opportunity for us. The reason that nobody else is farmers cannot keep up with the wine growth and the wine consumption is because, much like you guys mentioned, they're kind of mom and pop, here in Texas as well. These vineyards are, 50 acres would be considered a big one here in Texas. A lot of hand labor. So they've just got a ton of hand labor in those vineyards, pruning, harvesting. As you all know, hand labor means high cost. So we're the only fully mechanized vineyard in Texas. So we're bringing California technology, huge tractors. We can run 350 acres with 3 people. And a vineyard of that size that's not mechanized would take about 80 to 100 hand laborers. So we have higher profit margins because our costs are dramatically reduced. We've got, just scalability from an economies of scale perspective. And it's not something we're going to do forever. Once we fill the supply gap, we're going to take a break. And, there's a lot of grape needs further kind of in the central US and even on the East Coast, but we're focused here on Texas first. So it's been a lot of fun. There's a lot of science involved as well that I never expected I would learn about grape growing, but it's really been enjoyable. We have a vineyard operator as a partner. They're viticulturalists, biologists. I mean, they're just, all the science that's involved. They operate these vineyards for us. So.
Yeah, it never ceases to amaze me in the agriculture world, just how tech they get. And they have to be really just to be competitive and deliver and do all that stuff. But that's pretty cool.
Yeah, and I think. Go ahead, Mike.
No, you go ahead. I was going to say something in context.
I was going to say we get that question. Well, how come Texas farmers? Why don't they just convert their vineyards over? Because it's the way the vineyards are trellised. It either looks like a hedge, like a really tall hedge of grapes, or it's just what's called high wire, where the grapes hang just on one line. And if you want to mechanize a vineyard, the tractors will get all tangled up in the hedge of vines. And so you need a high wire mechanized vineyard. It's very costly to convert a vineyard over to that. And these, machines are expensive. One tractor is $550,000, comes over from France. So it's very difficult for mom and pop farmers to convert over. And we're not taking their business. They're still going to sell. A lot of them are premium and ultra premium grapes. We're going for the bulk kind of dinner table wine type market. So we're not stealing business from them, but we are going to fill that supply gap and really control the grape supply here in Texas. We'll control about 60% of it in the next few years.
That's awesome.
Yeah.
And you are also syndicating these ventures, right? So ins and outs of that, your investor base and mins and returns and all that kind of stuff.
Yeah, I mean, it's funny. Like you can syndicate anything, as we're all obviously realizing. As long as the returns are there for both parties and makes sense, especially for your investors, you can syndicate anything. But we use the same attorney for our syndication. The only thing that's a little bit different in this space is our debt is recourse debt. So we're signing on about $7 million of debt for every vineyard block that we put in. So when investors ask, like, do you have skin in the game? It's like, we got a lot of skin. We're all in on these things. So the debt's a little bit different on that side, but very similar, like tax benefits. We run cost segregation on the vineyards. We've got very similar tax benefits as our investors would see in multifamily. It's interesting because our investor kind of niche has been a lot of syndicators, actually, a lot of active investors that are looking for long-term cash flow. And then we've also got investors that have, been with us in multifamily projects and like the idea of just a legacy play. You plant these vines once, they grow for 25 years. So it's, they're not having to flip their cash every 2 to 3 years like they are in some other investments. So that's been an attractive thing for them.
That's an interesting, 2 interesting avenues there. But let's talk about the debt a little bit. So how is that? It sounds like it's different than with a structure on it, right? And a I don't know if you call it a standard revenue generating type, business on it versus an agriculture. But it sounds like your recourse. I don't know what your leverage ratio is, and hold term and all that. But.
Yeah, we're 60% leverage, so we're not as highly leveraged in that space. It's an ag loan.
Mm-hmm.
It's an ag loan with construction kind of built in on top. We actually purchase the land with cash, and then we roll it into long-term debt. But our equipment's financed separately on its own separate equipment loan, so that makes it a little bit easier. And it also kind of functions like a credit line. So or a line of credit. We don't pay on it unless we're pulling from it. So which is helpful because in the first couple of years, we're not spending a ton of the money until the 3rd year on equipment and things. But,
and you may not be, I don't know how long it takes to start generating the revenue, but it's probably not in year 1. Like you're planting the seed, so to speak.
Right. It is a game of patience. We've told investors that, my dad and his dad jokes. He's like, the juice is
When are we going to get our first cash flow distribution?
right. It's going to take time. It's going to take the fourth year. You get fruit on the vines in the third year. We don't sell that fruit. We really hold the vines back from full production. They want to scream out and push as many yield, as many tons as possible, but we don't like that. We want to build a really strong wood stock. So we really hold them back for the first 4 years. And then we push them to full production from years 5 to 25. So, investors are looking at a minimal return in year 4 and then getting above 33% in year 5. So full harvest, it's worth it. It takes time. So we always tell investors it's the part of your portfolio that you don't need cash flow right away. And you're thinking more long-term and maybe a legacy play for your kids or grandkids.
Yeah. And that brings up the other aspect I think you wanted to ask.
Yeah, I wanted to ask both of you, what's the projected hold period for this type of investment?
I'll let you guys go.
So, all right. Well, we're 5 years typically. But as any real estate investment, you reanalyze regularly and see if it's worth holding on to or selling. Of course, the market dictates as well, but we plan on the 5 years. And I'll also add with Keeley that we're also recourse because it's a different kind of asset. We're 70% debt, but yeah, that's certainly appreciating the skin in the game as well.
Yep. That's the easiest way to answer that. As soon as investors hear that, they're like, okay, yeah, so you're not going anywhere. It's like, no.
I think we have blood in there too.
Right. Skin and blood. Our hold period it's interesting because we give investors a 10-year horizon just for them to know, okay, here's your return over 10 years, but it will continue to cash flow until year 25. So it really is 25 years. They've earned 100% return by year 7, 200 to 300 by year 10, and then it cash flows 16% a year from years 15 to 25. So it's kind of an interesting model, but it's a couple decades.
And that's and on yours, I think, if I remember correctly, you do have a capital event in there in like the 7 to 10 year where you give investors back their initial investment plus the return. So then they're getting back their 100% on the money, and then everything after that is just. It's kind of gravy after that, or just, distributions after that.
We can refi it much like you would a, multifamily property. There's a ton of, equity built into it. We usually have over $1 million additional equity built in as soon as we purchase the vines and the steel, just even though they're not in the ground yet. So the bank, just the way they value it, is a little bit different than multifamily. We don't have to do the refi. We've got an 8% pro forma on our refi. Doesn't happen until year 8. So if we're in an environment where we're anywhere above 8%, we won't refi. It'll still cash flow double digits. So It is nice to have that flexibility.
Adam and Justin, you guys, do you write with a refi in the middle, or is it just a kind of a 5-year target, and you either sell a little bit early or late, or however the business is shaping up?
It's really a 5-year target we've set. With obviously the caveat that if it makes sense, we'll do a refi sooner, but it's not a planned event. It's a planned 5-year hold.
All right. What else then?
And Keeley, for you guys, what's the minimum investment?
75.
75.
Yeah, we raise about $7.5 million per vineyard block.
Oh, wow.
Yeah.
All right. Excellent. Well, I suggest we jump into round 3 here and get a little bit more into some of the details, right? Yeah. Gloves are coming off. I want you guys to get dirty. No low blows. No low blows. But we keep it clean. Keep it clean.
When I saw that, I'm like, why'd y'all invite me? Like, because I'm like, oh, I like their name, Happy Camper Capital. Like, right? I'm not the fighting type. I'm like, I like what you guys are doing.
You can't dog on the Happy Campers.
No.
That's right.
All right. So, I have a few things I want to jump into here in round 3. So, maybe we'll start with you, Keeley, but let's talk about risk. Kind of what are the risks that investors can expect? I would imagine with any type of agricultural venture, you're looking at external factors like weather, pests, those kind of things, maybe even just the quality of the fruit, and how you mitigate that.
Yeah. The biggest risk that investors that come to mind for them first is typically fire, weather, disease, because people hear about a lot of fires in California and vineyards. A lot of the vineyards in California, insurance will not renew them, which is unfortunate for a lot of those vineyards, trying to go into a season where their whole vineyard could be destroyed. But where we're growing in, let's say Northwest Texas, it's called the High Plains AVA. So it's right outside of Lubbock, Texas.
Mm-hmm.
It's so flat. There's no trees. I mean, if you see any trees, it's because there's a homestead in front of a farmland.
You can see the Rockies from there. And,
you can. I mean, it is so flat. It is just flat farmland. So you very rarely see any fires. There's so much dirt out there that it's hard for fires to catch. The other thing that people talk about is, what about disease or bugs? You typically get disease and bugs when you've got a lot of humidity. It's really dry out there, which is why it's the prime grape growing area for Texas. So you get really hot days, very, cooler nights, very, very dry. So we don't deal with a lot of disease and bugs. We do deal with weather. You get a lot of hail out there. And we can tell you that from owning multifamily properties.
Yeah.
Hailstorm comes through and tries to destroy your roof, at least a few times every season. But you do get a lot of hail out there. The way that our vineyards are trellised are, from a high wire perspective, you've got a canopy covering the fruit, which is just the leaves, right? So that does protect it. You will get some loss from hailstorms. But the great thing about the vineyard is that we have multi-peril crop insurance. So a lot of vineyards in Texas and in California, insurance is expensive. And so a lot of the smaller mom and pop vineyards can't afford insurance in Texas. But because we've got economies of scale, we've got coverage. They'll cover 75. If something happened, hailstorm came through or tornado, it'd probably have to be a tornado, like an F5, to wipe out an entire 350 acre vineyard. Yeah. If that were to happen, we have insurance that covers 75% of our projected harvest. To get that, we're paying $600,000 to $800,000 a year in insurance premiums. So we definitely built that in. I know it's like good for the insurance company, right? But it's a nice hedge. We can only do that just because we've got economies of scale. So we're grateful for that insurance. That does make our investors feel quite a bit safer going into this. Doesn't help our winery clients because they don't get fruit. But we have spread our vineyards out, at least 15 to 30 miles apart. And so that does give them more confidence that, if we don't have fruit from one vineyard, we can supply them from another. But those are the biggest risk.
That commercial, that insurance is commercial, I guess, or does the government cover agriculture?
No, it's commercial. It's multi-peril crop insurance. It's our vineyard partner, Mason's the one that sources that because he's used it many times before. But I don't know a lot about it. Mason knows all the details. I just know it's expensive. I know how much it gets into our profits every year, but it's worth it.
Yeah.
I'll kind of get both of you guys. Well, go ahead and talk about maybe some of your risk factors as well on the Happy Camper side.
Well, I'd say biggest risk factor we actually thought about at the beginning, we just didn't think it was going to hit us so soon, was fuel prices. So when we actually set our first underwriting criteria, we weren't looking at any campgrounds that were more than about 2 to 2.5 hours from a major metropolitan center. Yeah. And part of that, it was from other factors too, not just fuel prices, but also labor force, suppliers, all the things that we were going to need to operate a campground. Turns out this year that ended up being incredibly vital because what we saw is, well, we didn't see lower occupancy or users in our campground. We did see a difference in where they came from. So whereas before you might have had more interstate users who were vacationing or they were on their way to somewhere stopping through your campground, we would see a lot more out-of-state travel. We were seeing more people who were within 45 minutes of their home, who were just, they still had the toys. They still wanted to get out and play with their RVs, but they didn't want to spend, gas to get across the country.
Yeah,
so
$1,000 on a trip.
It ended up being quite fortuitous that we weren't buying places in the middle of nowhere. So that's certainly one threat that I think could threaten some of the ones that were on the way to a destination long distance. We also saw that in 2020. And actually that was part of what really solidified that for us is at that time, those smaller ones that were just a stop on the way to a destination, they were the ones hurt with all the travel restrictions and all the state different regulations going on in 2020. So that was one of those things that steered us away from it that was really fortuitous. The weakening economy, could affect discretionary spending. I mean, this is a vacation destination. This is certainly discretionary spending. We've seen survey results that suggest it's going to take a lot worse of an economy to really have a big impact. However, we've already looked at this from the start. that there's an opportunity in here that worst case scenario, if we went into a total depression, we can turn these into residences. We can convert the use and at least have some sort of income. It wouldn't be the revenue that we want to see, but it would be an opportunity. Natural disaster, kind of the weather, of course, is always something that can affect us as well too. Some of the prime places people want to buy are in the Gulf Coast, and so Florida to Texas area, and as you know, I mean that area gets hit by hurricanes. So insurance is expensive, not as expensive as vineyards. Apparently, our most expensive policy is $120,000 a year, and that's on a marina campground. But one of the things, similar to what Keeley's doing is we have a policy in place that will cover lost business income, at least up to our pref. So if we were to have a total loss event, we'd at least be able to cover our pref on that. So that's a big thing we look at. And of course, I guess I'll mention one of the ways we hedge these risks is the fund, for example. So if we were to put all our eggs in one basket per se and have one syndication that was a property, let's just say in Florida, and it gets wiped out by, a hurricane, that property's offline. We might get, some insurance money on that, but it's not going to hit its potential. But if we put that in with 7 or 8 other properties into a fund, we at least have the benefit of the other properties keeping the fund going. That's right.
Okay, nice. Yeah, and he covered most of it there. A little bit about the weather. Of course, I don't want to, hammer on the bad part of the business, but it's kind of like the ski resorts. If they don't get any snow, no one's going to go skiing. If it's raining all the time, no one's going to really want to go camping. Of course, there's people still out there, like some diehards, but if it's a really bad weather year, like we could potentially take a decent hit. But it's also how you adapt and adjust to the business model, and how can you create other activities and opportunities, for people to still want to be outside or do something away from home.
Yeah, Adam, you touched on it. I think this was something I wanted to ask each of you with the talk of, are we in a recession? Is a recession coming? How bad is a recession going to be? How long is it going to be? All of that kind of stuff. I think interesting observations from your point. I was going to ask the same thing of you, Keeley, and I think it's a bit contrarian. I mean, we have a land business, and when COVID hit, we were we really started buttoning everything down, thinking, here it goes, and it went quite the opposite way. I mean, we had to hold on just to keep up with sales and need and all that stuff. And I think, I hear over and over again that in a recessionary period, alcohol and wine sales go up. So, you may be cheering for, give us a long, hard recession.
Yeah, they definitely don't go down. We've actually looked at some research on that, and they go up slightly, but they, I would say they relatively stay about the same as whether you're in a recession or you're not. And we're not in the ultra premium market. I mean, we're in the table wine. Problem is, like Texas, a really good Texas wine, like good quality, that's $40 is $20 in California. It's just our grapes are so expensive. So a lot of these wineries are just trying to bring down their price of table wine. So I don't think we're going to price ourselves out of the market in a recession. And even if it went into a recession for the next 4 years, we're just kind of operating behind the scenes and building really strong vines. And, we're not coming out of the gate with expectations of returns until year 4 or 5 anyways. So we've kind of got this little shelter over the next 4 to 5 years for each vineyard block that's been helpful. Not to say that it's, this recessionary period, I guess, depending on how you define it, that it's not hurting. I mean, it's definitely like you guys mentioned, our fuel costs have gone up. One of our biggest purchases is steel. We pay more for steel than we do for vines. We buy 240,000 T-posts for every vineyard block. And that has been a challenge. We're starting to see some of those supply costs come down, but we actually increased all of our supplies an additional 75% in our pro forma this year, just not knowing how high they could go. Pleased to say they're starting to come down. So that's been nice. But there's a lot of uncertainty and unknowns going into 2023 with the Fed. Good old Fed, whatever they decide to do to us.
Well, the interest rates have certainly been interesting for us, on the loan side. I'm sure you too, Keeley, but it's definitely changed the market on a lot of these assets. Some people are still living in the space of my RV park or other location is worth way more than it should be today than it was 6 months ago. So that's certainly a thing. In recession, of course, we're all in an opinion on different matters of that. I think we're certainly in it already. We have a lot more people smarter than me saying that it's really coming to button down the hatches. I don't know that it'll necessarily impact us a whole lot. The RV sales are still very high. We're still catching up from COVID. We're still anticipated to be number 2 or 3 year of all time on deliverables for RVs, which keeps our industry strong. And I heard a saying the other day that I really appreciate, and it's COVID accelerated all trends. And camping has always been a growth industry, and it really jump started in 2020 as we all know, travel internationally was a problem, but we don't see it as going down at all. Just maybe slowing from where it's been since COVID started.
Yeah, maybe not accelerating as fast as it was,
Yeah.
right? Just kind of a reflection back down to normal.
Mm.
What about on the tax side of things? Depreciation in either of your syndications?
Yeah, we can depreciate our assets. It's not as high as multifamily, so we are trying to market that. Some multifamily people really have taken the cost segregations into practice. We can do that as well. It's just not as high as a percentage, but it's certainly there, and we are taking advantage of that.
Like around what level?
I'd be lying if I could spit that off the top of my head, but
Okay, fair point. Keeley?
Yeah, we actually use the same firm. I'm sure you know Madison Specs to run cost seg on the vineyard. So we can actually depreciate quite a bit. We could even depreciate the aquifer that the land sits on top of, which is,
Wow.
yeah, I know, right? A lot of unexpected stuff. Our CPA is passive investor in 17 syndications. So she likes the tax game. So she's making sure that we have everything that we could take advantage of for that. But we're seeing about a 78% tax benefit overall. Even with bonus dropping to 80% in next year, we're still at about a 42% year one benefit.
Okay. Great. And I didn't get I don't have a clear picture of like, what are the average annual returns on each of your investments? Like Keeley, what do you guys at least market on the vineyards on what the total returns are? And I don't, maybe you two-phase that. I'm not sure how you.
Yeah. I mean, we kind of do it over 10 years, right? So over 10 years, it's a 250% return. And then after that 10-year mark through year 25, it'll cash flow about 16 to 18% per year.
Wow. Okay. Like an annuity almost.
Yeah. But better.
In our space, it depends on the deal. I would say our underwriting criteria, if we're actually going to take a deal forward, it needs to hit an average of about 15% cash on cash across the 5-year hold. We're targeting to do it's going to be somewhere between about a 2.2 and a 3 equity multiple in that 5-year hold is usually what we want to see and something that we're going to underwrite.
Okay. Any final questions on your
final question.
All right.
Do you guys have questions for each other?
Yeah, right.
Well, I mean, I would love to know, because one of the things that I think is really important to serve your investor database is to make sure that you have resources, right? So if we have investors that maybe they're already in the vineyard and they've done multifamily with us, but they want something different. I mean, I love to refer operators. So who's your ideal investor that you would be like, oh my gosh, we'd love to take them in. They're amazing.
It's a good question. Thanks for asking that, Keeley. We were actually just sitting down doing our business planning the other day. So I actually have a profile of that person. And for us,
I love marketing avatars, right?
Yeah, exactly. Yeah. I'm shifting papers over here, but our ideal is somebody who's sophisticated, someone who's risk tolerant. Obviously, this is an alternative asset. This is something that really hasn't been an investment asset ever. I mean, very similar to what you're doing. I'm certain that it hasn't really been an investment asset before, aside from the big institutionals that were doing this. And then of course, someone who's just experienced in real estate investing, somebody who gets it and understands it. We're happy to educate people. And even those who come in with experience, we spend a great amount of time educating, on what we're doing, but it's, certain tolerance for risk and just sophistication are the main things we're looking for investment partners. We take investment partners of all sizes, from retail to larger groups. So
I wonder if you ever thought about putting a little sign up at your parks, like, hey, want to own a piece of this? Contact Happy Camper Capital. Like, it's, the people that have RVs have got money. What if they invested in their own hobby, think it'd be pretty cool.
That's right. We actually have a piece on our Beyonder Camp website, the management side, about people who want to invest in the space. So I just throw it out there, figure somebody who's in the space gets it. We work with sellers. We have an acquisitions team that they're phone warriors, cold calling, mom and pop campground owners all day long. And some of those are our best investment leads as well, too, because they get the space. We don't have to sell them on the asset.
Right. Yeah. They sell and reinvest back into the deals or just invest,
right.
period.
Yeah, it's we have to be careful how we structure that, but yeah, there's a system for that for them to get in, or at least get in on one of our future opportunities after we purchase theirs. So that's an opportunity. Well, Keeley, I'd ask you the same question back. I mean, it sounds like from what you're describing, the ideal investor for you is somebody who's got a longer horizon, since you get that first period of getting the vines up. But what's your investor profile?
Yeah, thanks for asking. I mean, I feel like it's interesting. It's a lot of active investors that, syndicators that have got a pile of cash that, they want to put to work, and maybe they want to diversify it outside of multifamily. It's also been a lot of passive investors that, as a piece of their portfolio, they don't need cash flow right away. It's interesting because we don't have there's not a lot of older, I would say 67 in their 60s and 70s. We've gotten that before. We have a younger investor that's like, I'm dragging my dad into this. And he's like, I don't care about what's happening 20 years from now. So, it's typically not the older generation unless they're thinking about it for their kids. But people that are patient, and they're excited to wait. We really feel like we're building a legacy in Texas, and we want people to be a part of it, no matter where they live, be a part of this Texas, the great state of Texas, and all the obnoxious people that have all this Texas pride. We just want to bring as many people into it as possible.
Yeah, we know how well Texas has been performing lately. It's very popular down there. Do you ever anticipate moving outside the state?
We've thought about it. We'll fill the grape supply as of today's demand by about 2025 with our vineyard blocks. And so at that point, I think we're going to pause for a year and kind of reevaluate those markets outside of Texas that are also buying from California and are getting frustrated because there's, a lot of the California wineries are not able to supply grapes outside of their own state right now. So we've definitely talked about it.
You mentioned that you've added about 650 acres. Is that
what
you said? How big is each one of those blocks?
A vineyard block is about 320 acres, usually 290 planted. So the additional acreage is for barns, turn rows, right? Enough room at the end for our big tractors to turn around. We actually, on the one that we just closed on, is 386 acres. Got a great deal on it. So because we got a great deal, we're going to plant 15 additional acres. That'll take us to 305 planted acreage. So, but the model's 320.
Okay. Well, Mike, I'm just going to go ahead and say that I think we've got the investment model down for your listeners, which is you invest in both today. You get the short term with us,
yes,
and then you get the long term with Keeley. So there you
go. You're stealing my thunder.
No brainer.
Yeah,
no brainer.
I actually, I was gonna close with that. So we could probably pivot on here. So for us personally, you guys are sharing two things that we are in love with: wine and camping. Yes. I mean, it's great. And then, yes, to your point, when you match up great returns over 4, 5, 6 years with outstanding returns over 10 to 25 years, then the investment model is set. So just you guys need to get a parent company going that kind of has these. So
yeah,
that's right.
We certainly appreciate you guys kind of running through your business models, the ins and outs, and sharing the details. I mean, it was awesome. We will definitely be considering, I think we're on both of your investor lists, but yes, sure. Definitely future investments coming up for Lygia and I would say, definitely.
Anyway, guys, throughout your matchup, Mike and I were looking for key factors like resources needed to generate cash flow, potential ROI versus risk versus reward, and your level of enthusiasm. And I think we reached a decision.
We have?
Yeah.
I'm going to say we're going to take 1 minute to discuss. I haven't reached it, but we'll mute you guys.
Oh boy.
Love it. I've never heard y'all's business model before, so it's pretty cool. I'm excited to share it. I'm going to find somebody that's an enthusiast for. There's actually a guy that lives in my building that is just, loves that type of stuff. So, and he might be an investor. So
But I think I'd be interested to take a look at your marketing collateral too, just to see what your profiles look like. So
thank you.
Yeah.
Y'all tried to
Awesome.
create a
Actually
fight and you
have-
made friends. That's what you did.
Right.
Where friends are made. I love it. All right. So we actually have reached a decision, and it's a unanimous decision. So on the Cash Flow Fight Club podcast, it's a mouthful. We truly believe there are no losers, and these are both great investments, but rules are rules, and we are going to crown a champion. So the winner of this particular matchup is Miss Keeley Hubbard with Texas Vineyards Investing. And
Thank you.
aside from the long horizon, there's a unbeatable ROI, I would say, tax depreciation, and a pretty cool business model. So congratulations
Thank you.
Congratulations.
Appreciate
Yeah.
that.
to all of you guys. I mean, I really, these are inspiring. I mean, we're
Yes.
just in plain old multifamily, and the land business is cool. I mean, but we're getting some other things there. So we're gonna reach for some alternative type investments, I think, here soon. But
Yes, for sure.
as they say in the fight business and in real business, this is a team sport. So because of that, we always like to end each episode with a little bit of gratitude. So, Keeley, who would you like to give a shout out to that really made a difference in your journey along the way? Special props, things like that.
You know, people would expect me to say my dad, and I love him dearly, but it really is my mom, because she's been in the corner behind us, like cheering us on when we didn't know how we were going to do it, how we're going to raise the capital, how we're going to make this work. She's always believed in us. She just always said, "You're going to do it. I just know you are." Never, ever doubted us. And I think having that backing you there's nothing like it. So
That's awesome. I love it.
Love you,
And
Mama.
please tell Ramona hi for me.
she's going to slap you for that. Her real name's Katie, y'all. And Mike he teases her and calls her Ramona.
Because you told me to tease her.
I know. I'm a teaser though. I see her this week. I'm going to tease her.
Okay.
Said that.
How about you guys, Adam?
I'll jump in. My gratitude would go to a gentleman named Alan. He was my team lead when I was with Keller Williams when I first came out of law enforcement. And, he was the one who taught me everything I know about running a business. It really got me started, and actually was kind of the guy who was by my side as I was getting out of my W-2 and just, took me under his wing, even if it was just to be a launching pad for the next venture. Certainly where I learned everything I know, and kind of what got me inspired in coaching and leading others.
Awesome. Thanks.
And then I've had a couple of mentors along the way. One of those being Jeff Young. He's a local kind of celebrity in a way in the multifamily business. He sat down with me for many breakfasts along the way, and just kind of taught me the ropes a little bit, what to look for. And, it's all the networking involved. So it's not just one person, but he certainly stands out.
Awesome. Thanks, guys.
Keeley, Justin, and Adam, thank you so much for coming on a show, sharing your insights and the type of investments you're in. For the listeners that are inspired to take action and want to reach out to you, what's the best way to reach out? Keeley, let's start with you.
Yeah, you can find us just hubbardcapitalgroup.com or any social media platform. Send us a message. We'll say hi. We'd love to chat.
Awesome.
How about you guys?
For us, the easiest way is through our website, happycampercapital.com. We have an investor portal, so listeners can jump on there. They can request access. We'll get them in right away so they can take a look at what we're doing.
Love it. Great. So happycampercapital.com and hubbardcapitalgroup.com. Sweet. All right. So, again, thanks from me. And for those of you tuning in to the show, thanks again for investing your time with us on the Fight Club podcast. We certainly had a blast. We learned something new. We hope you did too. If you want to hear more fun and learn more great cash flow ideas, please follow, subscribe, and share the show. Lidge and I, we truly believe the beauty of cash flow is having your money fight for you instead of you having to fight for money. So whether it's one of these methods or something else, we encourage you to dream big and, most importantly, take big action. So thanks for coming on the show, guys. And for everybody else, we'll see you next time.